All right. Good afternoon, everybody. Welcome. And a little busy day in the market. And today, I'm going to focus on range bound trading. We're going to kind of go through the process, look for a trade today, and hopefully this will be a help to find out, okay, on a day like today, would we put a range bound trade on? What does range bound mean? And how we would go through the process of finding a trade and what type of trade. And so that's what I wanted to go over today. And hopefully that gives you the process that you can do this yourself. So let's jump in here and let me share the desktop. All right. So right now I'm showing the Thinkorswim chart, and let's go through this process. And you can see, let's see, you should be able to see my Thinkorswim now. Yes? You can see my Thinkorswim. Okay, perfect. Perfect. All right. So let's go through this process. We're going to answer a few questions. Do I trade today? All right. So if we're looking today, SPX is up 1%. Should I put a trade on today, like a range bound trade? What trade type should I do? Calendar, butterfly, what should I do? And the size. And we're going to answer those questions in a few minutes here. And I'm going to go through a checklist that you can use. It's 6 things that you can answer these questions. And then what I'm going to do at the end is, okay, what 2 trades will we pick for today, right? And I already have an idea what I'm going to do. But first is range bound. What does range bound mean, right? Does range bound, range bound means, okay, we're in a certain range, but for range bound traders, we don't want it to move too far, right? So I'm going to go through some criteria with you, but range bound, when I look at range bound, I'm also looking at deltas, right? Range bound deltas for SPX trades are going to be somewhere between around, just think for the most part, 1 delta long, 1 delta short. If I put on a trade, that's about 1 delta long, 1 delta short, it could be a little bit more, 1.3 or minus 1.3. That's range bound to me. And so I'll go over actually 3 different ideas. So let's go through this process, and this will be recorded. Number 1, I'm looking at this chart, right? This is just a 3-month chart of SPX. And from this chart, what I'm going to do is focus more on the last 10 days, right? The types of trades that we put on, range bound trades, butterflies, calendars, double diagonals, could be some put credit spreads, iron condors. Those are types of range bound trades. And we're going to put them on anywhere from 10 to 15 days on the low end to 30 to 35 days on the high end. And for those trades, when we put them on, we're going to be in the trade about 30% of the duration. So if I put a 20-day trade on, I'm looking to be in it 5 or 6 days. A 30-day trade, I might look to be in it 8 or 9 days. And this is the core of what we do range bound. Do we trade some 0-day? Yes. Do we trade some 2 or 3 or 4-day stuff or 5-day? Yes. Is that the bigger part of what we do? No. Do we also trade in what we would say a long portfolio? Covered rights, cash secured puts? Yes. I'm not going to talk about that as much today. But instead of covered rights, we would look at something we would call a poor man's covered right or a diagonal type trade. And instead of cash secured puts, we would do a put credit spread. Why would you do those? They're tremendously cheaper dollar wise and better yield. So that's what we would do. So today the focus is range bound. So when I look at this graph here, I'm focusing more on the last 10 days because if I'm going to put a trade on from 10 days duration to 30 days duration, I'm only going to be in it a week, right? So I'm more interested in giving more weight to what's happened lately. Yes, I'm aware of what's going on the last 3 months, but from what you're looking at here, could you say it's kind of range bound? Is it two-way? Yes or no? Are we kind of two-way range bound? What would you say? Yes or no? I would say yes, it's range bound, but it's very, the candles are bigger. Over the last 8 or 9 days, we've had maybe 70-point swings from high to low in SPX. So number one, if I look at range or trend, I would say range, right? But I would say choppy, right? Have we get a bit of a range? Yes, but it's choppy. I wouldn't call it. I mean, today you could say, as of today, right? We're up quite a bit today. So I would say range bound but choppy. Number two. So this is a criteria, 6-step criteria to determine, am I going to trade today a range bound trade? What type of trade will I do? Trade that benefits if volatility goes up or down, and then the size of trade. Number two, ATR. I have ATR here of 14-day Wilders, and you can see what has happened. The ATR, you say, Dan, what's the ATR? It just measures the distance between the high and the low, right? So you can see it's gone up. It's gone up, but it's stabilized. Candles were pretty big here, bigger size candles, a bigger range. We've calmed down a little bit, but that's up, right? So do we normally want the ATR? So in terms of this, number one, range bound, I would put a yes for range bound trades. ATR, it's level, but high. I mean, this would be kind of iffy, right? You generally don't want the ATR trending up. I'd rather the ATR trending lower to get smaller candles, something like this. Number three, moving averages. I'm more looking at, did the trend change? No, nothing's really changed, right? We can't really say we've broken out, but we've been in an uptrend, right? That hasn't changed, right? We've been in an uptrend for a while, so that would be, at least for me, things are pretty stable. And then number four, today, right? I would put today, have we moved much, 1% or more? We have. We're up about almost 1% in the SPX. When you start getting 1.2, 1.3%, 1.4, 1.5%, I would stay away from range bound. There's nothing range bound. I mean, this is kind of borderline, but so at 1%, I'd still say yes for range bound. But what these all have in common is they have to do with price move, right? What are the two big things I'm looking at here? I'm looking at price movement because that's the number one thing that affects range bound trades. Number five, I look at VIX. Is VIX in the normal range of the last year? You say, Dan, what's the normal range of VIX over the last year? Probably about 13, 14 on the high end, 22 on the upper end. April, we went a lot higher, but I'm taking out a lot of the craziness. The normal range would be maybe 13, 14 to 22. Are we in the normal range? Yes. So that's good for range bound. And we've dropped in the last week. We've come from 28 volatility a week ago to 16. right? So we're at 16.5. So four of the criteria to determine should we trade today, trade type and size, have to deal with price. One deals with volatility, and then the last one deals with news, right? Catalysts, we'll call them. And as you look, obviously the CPI was a big catalyst today. Is this surprising? No. This was a big catalyst for today. We knew it was a big catalyst. Doesn't mean it always has to move, but it moved. Now, so as I'm looking to put a trade on today, what catalyst am I looking at? I'm looking at next week. Next week, on Wednesday, you have the Fed, FOMC. That's a big one, potential catalyst. Doesn't mean anything has to happen. And what else is going on? In the later part of next week, Wednesday, Thursday, Friday, I haven't checked exactly, but usually that next week is going to be a lot of your big earnings, right? A lot of your tech stocks, a lot of your big earnings. So are those catalysts like today that can move things? Yeah. So that's staying in my mind. All right. So now when I go through all of this and say, I've gone through some of these criteria, look at the charts. I mean, we're still in an uptrend here. What would I do? Right? So here's what it would be. Number one, would I trade? Yes. Right? But because of the choppiness, because of ATR going up, because the candles are still quite big and we're at the upper end here price wise, I might say, you know what, size wise, I would trade maybe 60% of my normal size, right? Right. If I normally do 5 contracts, maybe I'd do 3, right? Why? You have quite some big catalysts coming up towards, especially starting next Wednesday, uh, because of today. It's kind of moved it a bit, but we have some catalysts. So I definitely would trade, maybe smaller size. Number three, what type of trade would I do? Would that be clear to me? Yes, it would be. You say, Dan, what would you do? I would do a long Vega trade. We've dropped 11 points. Now we've dropped 12, 13 points of volatility in the, or whatever it is, in the last week. So it is 16.52. I would get something long Vega, something that would benefit if volatility went up, right? If I was just doing one trade. And you say, what would that be? I'm going to go over an example here in a second, a calendar. Now, if I was putting multiple positions on, right, I'd still want to be at this volatility level a little bit long Vega, right? If we were, 13 or 14 volatility, a bit more long Vega. So a couple of trades that I'm considering today would be a calendar. Now, this is a little different. You might not have done a double long diagonal. I did one yesterday, and with the 60%, with the big move up today, a range bound trade, it made 8% in one day. So I'm going to look at that again. And then the last thing, if I were to get 2 trades on long Vega, then I would consider something like a short Vega trade, like a put credit spread. So that's kind of my analysis. Now I'll go in. Does that make sense? What I said so far? Kind of the criteria, the analysis, and I'll look at 3 trades. Doesn't mean there's not other trades. Now, here's the other thing. Am I talking about spec trades? No, I'm not. Right? That's a different conversation, and that's maybe for another webinar. Spec trade. What spec trade could I have done? We talked about spec trades yesterday, like reverse iron condors is a great spec trade. Has anybody ever done that, a reverse iron condor? You say, well, what is it? Folk were doing it yesterday for today's expiration. maybe buying an out of the money call and put, that's a long strangle, maybe 30 delta, and then sell a further out of the money call and put 20 points away. That would be a trade that would get you long deltas on the way up, short deltas on the way down. That's was a good trade. It worked well today. So, okay, now that we have this, let's look at the three trades and at least model a trade. All right, so trade number one, we'll look at a calendar. So I'm going to go through three trades pretty quick, but I want to give you an idea just how I would do it. Now, you say, what duration do you go with a calendar? I would probably go, could you go, uh, you know, 7 days out? You could, but I would go more either 14 days out. I'd look for a Friday, or 21 days out. Why would I do that for a calendar? Well, I think the candles have not gone away, where you have a bigger ATR. Next week, do I expect more volatility next week? Yes. Why? We have a lot of catalysts on the table. What are the catalysts? FOMC. A lot of the big tech earnings are coming the later part of the week. So one way to get a little more price protection is duration, right? So I might look at I normally would do a 2-week calendar, but maybe now I want a little bit more room, right? So I do a 3-week calendar. Do I normally do a 3-week calendar? No. But so here would be an example of one I would consider for today. So I would go, and let me show you how I would set it up. This might be a little bit different how you think of a range bound calendar at the money, but here's something I would do. And let me explain. And then if you have any questions on it. All right. So this would be a calendar that I would put on today and feel comfortable with it. All right. So what is this? First, what is a calendar? A calendar is a mixed month spread. I'm buying the further out, selling the closer in, same strike. A diagonal is a mixed month spread, buying the further out, selling closer in, different strikes. So this is a calendar. We're currently at 6,800. Dan, why are you placing a calendar 40 points under the market? Are you bearish? Not really. I don't know which way the market's going, right? But I do know we've gone up quite a bit. And so I would want to put it on close to delta neutral. Even if we put it at, let's just say, 30 points under the market, 67, 70. Let's go with this. So if you look at this, I'm placing the calendar at 67.70. This is called an under the market calendar. We're currently at 6,800. Is it bearish? No. How do I determine bearish or bullish? By the deltas. These are pretty neutral. Minus 0.07, that's pretty close to zero. So I'm putting it on at 6,800, so it gives me extra room to the downside. This is my expiration break even. So I've got from 6680, 6800, I've got 120 points to the downside. So I've extended my downside break even here versus if I did it at the money, right? So this is going for about 555. If I did this right at the money, you could see, let's say, what if you did it at 6,800? If I did it at 6,800, I'd be a little bit delta long, but I'd only get to here for my expiration break even. So I'm getting an extra 30 points to the break even, and I'm basically neutral. What if we go up? If I place a calendar 30 points under the market, I'm fine. I started out basically neutral. I'll be fine. If we go up 1%, I don't even get a delta short. So this is the type of calendar we've been putting on this year because the market's been going up. As we go up a couple days up, right? We'll place it right under the market. Then when the SPX has a down day, it comes to our strike and you're able to make some profit generally. So that's candidate number one, a calendar under the market that we would do today. Any questions on this? I'm not going to get into everything today on each one. We don't have enough time like adjustments, but any questions that come to your mind about when you're looking at this calendar for a trade idea for today? Why puts? So here's the thing. Does it matter if you do puts or calls with calendar? It doesn't, right? In other words, if I do, let's go calls. So here's puts. I'm minus 0.05, gamma, theta. If I go to calls, it's basically the same graph. Now, is there a difference? There is. Which is going to be more expensive, puts or calls? What do you think? Now, NCA had a good question. Is delta neutral when delta equals zero? No. On a $6,800 vehicle, I would, what I consider delta neutral for range bound trades, NCA, is more like 1.25 plus to 1.25 negative, right? That's what I consider more range bound. And you could tweak those numbers, but I'm just giving you a rough estimate. Why not a double? Joe, there's nothing wrong with a double calendar. What's the advantage of a single calendar over a double calendar? You get more theta, right? Uh, you could do a double calendar, right? But here, uh, in a way, not that I'm getting the, I was going to say you get the best of both worlds. I'm starting a calendar 30 points under the market. So I get more room to the downside, but I'm not committing the deltas. Now, what I was going to say is calls are always more expensive than put calendars, the same strike. So does that mean because the puts are trading at 555, the calls are at 605, is there an edge in doing the puts? No. Are the puts cheaper? Yes. Do we do more puts? Yes. But there's a, I'm not going to get into it, but there's a relationship between the puts and the calls called a jelly roll, not the one we eat. And so they're not, there's no mathematical edge in one versus the other. It's just the way it is in the modeling. But I'll generally do the puts. If you said to me, what's the determining part? Will you always do puts over calls? No, liquidity. I mean, if the calls are trading much more than the puts, I probably do calls, even if it's more expensive. If puts are trading more, um, the thing you got to remember when you're doing, if I'm doing a $5 calendar, you cave in a nickel, right? That's different than if it's a $10 or $1,000 calendar. I'd easily cave in 5 or 10 cents, but the cheaper the calendar, the stingier I'm going to be when I'm caving in. So, anyways, um, with calls, calendar will be in the money. I mean, if you set it right at the money, I mean, it'll be pretty at the, I mean, at the money. But generally this year, I'm just saying, this has been the tweak that I've made to calendars this year with the way we've been trending up, run them under the market, and it's been really well done well. How many think skews are really important with calendars? How many people think skews are really important with calendars? What are skews? Skews are just meaning like for this calendar that we're doing here in the puts, A skew just means what is the difference between the implied volatility of the long and implied volatility of the short. So in this case, my long is lower volatility, 12.95. My short's a little above, we'd say a positive skew. Yeah. So in calendars, if you said to me, or any range bound trade, what's the most important thing by far, generally? Price, right? For range bound trades, I want it range price. Number two, for calendars, volatility. I generally want vols in the lower end of the range, looking for them to go up, right? It's not that I won't put on so generally I'm putting calendars on in SPX when we're in the teens, 14, 15, 16, 17. Doesn't mean you can't do well if they go up, but they could also come down. So generally I'm looking for lower volatility in the range. Number three, I would look at skews. It's not, but by far, this is number one, and this is number two. Um, now, so that's calendars. So that is something I would put on today. Number two, assuming I get on some long Vega trades, right? So if I do this trade, and let's say we're doing $1,000 trades, if you put $1,000 into a long Vega trade and you put $1,000 into a short Vega trade, like a put credit spread, you're always going to be long Vega. Dan, what do you mean? I'll show you. So this is trade number one. Let's assume we have this on, right? Number two, let's go out and do a put credit spread, right? I consider a put credit spread a range bound trade. You say, Dan, I don't understand. How can you say a put credit spread is a range bound trade? It makes money if we go up, it loses money if it goes down. Remember, part of my definition of a range bound trade is the deltas. So let's say I do a put credit spread, trade number two. And let's just say I'm just going to start out with a 20 delta put. So I sell the 6,600 put, and I just do a 10 wide. I buy the 6,590 puts. Does everybody see this? I consider this a range bound trade according to the deltas. You with me? What are the deltas? Does everybody see this? 0.79 is the deltas, right? Do we make money if it goes up? Here's where we're at, 6,800. Our short strike is at 6,600, 200 points out of the money. We're bringing in about $1.20, let's just freeze it at $1.25 credit. Now it's $1.25 credit. So if I do one of these, what's my margin or risk? $1,000, the difference in the strikes is 10. $1,000 minus 1.25 would be $875. So if I put 1,000 into the calendar, let's say each calendar I'm paying $5.50. If I do two of them, that's about $1,000. So about $1,000 or 875 would be the put credit spread, right? So it's 0.82 deltas long, very low gamma. The deltas don't change much. As we go down 1% or about 70 points, doesn't change much. So this can handle quite a move. It's the deltas are very, very low. But if I come, does everybody see that? So that's a put credit spread. I'd consider it range bound. If you combine the two trades, what do you notice? The calendar has long Vega of 115. The put credit spread has short Vega of 11. Not as much. So if you combine them, right? Now, technically what I could do here, if I want to put this is like $1,100 in the calendar. If I wanted to put just a little bit more money into this trade, maybe I'd make it 15 wide. So if I make it 15 wide, right, that'd be $1,500. It's 15 wide, 1,500 minus a credit near $2. So this would be a $1,300 trade. This would be an $1,100 trade, 2 calendars. And when you combine them, I'm still going to be long Vega, right? And I'd be 1 delta long on this trade. So that's something I would consider to do. But my number one choice would be a calendar today. I just mentioned the put credit spread because I wanted to show that that would be more range bound deltas. But if I did a couple trades, then I would, a couple long Vega trades, then I would add that. All right, any questions on a put credit spread before we go to the third and final strategy, which would be a something a little bit different? I'm guessing not as many people have done it. Any questions on a put credit spread on a regular basis as a range-bound trade? NCA says, are puts more dangerous since the market can turn quickly? I mean, they can be. You're right. I mean, the market can go down faster, but the key is having a good plan, right? So I'll just give you a quick plan here. You ready? So what would be a quick plan that, so first of all, would we rather put a put, let's just talk put credit spread plan, right? Would you rather put a put credit spread on a down day or an up day? Generally, we've been in an upward market. Yeah, you'd rather a down day or two, right? We haven't had many, but I'd rather a down day. I'd rather still be, if you look at the charts here, uh, ideally a down day, but we're still in an uptrend, right? But, you can look at charts and maybe have criteria, you know, I'll do it as long as we're over a 21 EMA or whatever you want to do technically, but I'd rather it be a down day, preferably still in an uptrend, right? We've been in an uptrend for a while, right? I've got a 9-day, what do I got here? I've got a 8-day EMA and a 21 EMA. Here's an 8-day, here's a 21 EMA. But once you have it on, right? So one idea, just if you want to no touch, just a quick plan that makes some sense is, okay, when I put it on, I sell a 20 delta put, right? And here you could see I'm bringing near $2 credit. But in this case, right, because it's 15 wide, right? Normally would do it 10, right? Let's go back to 10. Let's keep it at where you just start out. You can do 5 or 10. And I'd encourage you, if you're new to put credit spreads or credit spreads, start with 5 wide. You can do a 5 wide credit spread in a $6,800 vehicle for $400 or $500. So if you're doing 10 wide here, I'm bringing in $1.25 credit. This is costing me in margin or risk $875. So I might have a plan saying, look, I'm trying to make 10%. I'm selling a 20 delta put. So 10% of 875, let's say about $90, right? So if I want to make $90, where would I put in my order to buy this back? If my goal is 10% on this whole trade, where would I put my order in to buy it back? Anybody? I want to make 10% on this. Where would I put an order? And I sold it for $1.25 credit. Where would I buy it back? Yes, Joe, it would be 125 minus 90, it'd be a 35-cent debit. So I put a good till cancel order and to buy it back for 35 cents. Now, if I didn't want to get involved with adjustments and just say when to get out, I could say, look at two criteria, when to get out or a max loss. Either 15 to 20% max loss on this, or that 20 delta hits kind of this 35 to 40 mark, maybe closer to 40, whichever comes first. Let me say it again. Just a plan to get you started, right? There's one of 10 different plans. I'm just trying to give you something. Trying to make 10% profit. My max loss would be 15 to 20% of this number, or the 20 delta of the short put I sold. If that gets near in this 35 to 40 range, I'd get out. And I'll explain this in a sec. Does that make sense? How many think they could follow those guidelines? Wait for a down day to put it on. I mean, you could look at technicals, but that would be, how many think they understand that? How many would want me to go over that again? How many thinks they understand it? How many want me to go over it again? Yeah, why 15 to 20? Because a lot of times we'll go down, come back. The reason I sometimes put 20%, which would be twice this, let the probabilities work, right? Give it breathing room, which is important. And what I found over the years is when your delta of your short goes up 15 to 20 points, right? From where you sold it, you're going to get about the same thing. Yeah, you're going to get about the same thing. But these are criteria. But again, the bottom line is doing put credit spreads, it's a high probability trade the way you set it up, especially a 20 delta or less. But you can't let yourself lose 3-4 times what you make. That's risk management, right? How do I figure the 10% profit? Again, it's not on the credit. It's 10% on your risk or margin. So if this is a 10 wide spread, your risk is $1,000 less your credit. That's $875. So if I want to make 10%, it's 10% off the margin or risk. So 10% off this is around $87. I just rounded it to $90. So if I sell it for $1.25 credit and I buy it back for, what did we figure? 125 from 90. I buy it back for 35-cent debit. Then I made $90 divided by 875, which would be 10%. Yeah, you'll get a recording. You could look at it. If you have any questions on anything, just send me a email, Dan at Sheridan Risk Management. I'd be happy to help you. It's just getting used to it. But again, here's the key. How many think that they're going to understand put credit spreads or butterflies or calendars or whatever trade you think is good, right? How many of you think that you're going to understand it? Or how many would like to totally understand it before you trade it? Yes or no? How many would want to totally understand it before you trade it? Here's the problem. Are you going to totally understand doing an oil change on your car before you do an oil change? Are you going to totally understand fishing, right? Are you going to totally understand fishing without getting the rod and going out there? No, right? So you can get, yes, you should get some basic understanding, but to me, over the years when I've been teaching, I would kind of encourage newer traders, okay, start them out with one or two trades, do a calendar and a butterfly, something like that, every week for 20 weeks. And you know what? You'll get a lot better, right? At it, but you have to do it, right? And then what happens is you'll make it your own. You'll get better at it, right? Question says, if this trade was a standalone trade, would you consider using a hedge, say a ratio back spread on even XSP to make it less risky and cheaper with still a lot of delta to protect? I mean, you could, but again, here's the key. Here's the key. Is 0.82 a lot of deltas long? Is 0.79 a lot of deltas long? Am I probably going to hedge this? Is that a lot of deltas long if we go down? If this were standalone? Again, you're less than a delta long, right? I mean, if I was doing 10 of these, right? Let's say I was doing 10 spreads and this was an $8,700 trade. If I was doing that and you were concerned, right, on the downside, right? Are there hedges you can do? Yeah. I mean, could I go in and, okay, this is a 21-day put credit spread. Could I go out? I mean, I'll just give you a little example. Could I go out, you know, 56 days and buy you know, watch that. I'm just throwing this out there. Buy a 2 delta put for $6. You see what I'm doing here? I'm going 56 days out and I'm going to buy one put. You see this? All right, let's take it. If I wanted to do this, I probably wouldn't, right? But if you wanted, let's say you had 10 of these, right? 10 of these would be $8,700. And then I took $600, which would be about 6.5% to use as a hedge, right? Does everybody see what I'm doing? I'm taking a put. Now, how many would say, Dan, that's ridiculous. Why would you buy a December 19, 5,000 put? It's $1,800 out of the money. That's never going to help you. How many are thinking that? Be honest. How many are thinking that? Dan, there's no stinking way. I'm not putting it on for the price move. Why am I putting it on? Why am I putting this on? Why would I buy that put? Volatility, right? Let me show you an example. So let's say I buy this for $6, right? I didn't butcher the trade. We can still make, the total credit I could make, right, would be about $1,250. Dan, how did you get $1,250? 10 times my credit of $125. So I reduce the most I can make, $1,250, by $6. Now I can make $760, right? Still decent return. But how would this benefit me? This hedge, would you agree, is for a big event, right? April. in the market. We get a big move down. Would you agree? So let's just say next week, let's go to next Wednesday. And next Wednesday, we drop 200 points in the market. We go to 6,600. We go to the short put immediately, 6,600. Right? You with me? Everybody with me when I'm going through here, this exercise? So 6,600 points move, or 200 point move by next, whatever, Wednesday, Thursday, whatever. Is that realistic? No. Could it happen? Sure. Dan, why isn't it realistic? If we look at next week, Tuesday, the expected move is 64 points from now. Wednesday, the expected move would be 50 points or standard deviation, or 80 points. We're talking a 200 point move. So some craziness happens in the market. If we move down 200 points in the market, right? This says with just the put credit spread on 8,700, I'd be down around $2,200, which is over 20%. Everybody agree? But if we went down 200 points in the middle of next week, how many points do you think VIX would rise? How many points do you think VIX would rise if we went down 200 points in a day? Anybody take a stab? How much would volatility rise? Anybody? 20 would be a little aggressive, but I think, maybe VIX, if VIX were right now, we're VIX at 16. If we went up 200, down 200 points, I would say at least maybe 6 points. Yeah, NCA. So when I'm saying expected move, just think of one standard deviation. So they're saying Monday, and it's in 3 days, expected move is 50 points. What does that mean? That means there's a 68% probability between now and Monday, at the end of the day, we'll be up 50 or down 50 from where we're at. So if we're at 6,800 now, there's a 68% probability we'll be between 6,750 and 6,850. Does that make sense? That's the expected move. Expected move means one standard deviation. Expected move for Monday is 50 points. Means there's yeah, you got that. All right. So let's go through this. So we said we'd be down 2,200. Now with the hedge, just with that hedge, without moving the volatility, at 6,600, we'd be down 1,700, right? With the hedge, we'd be down 1,700. But we just said, with the hedge, and raise the volatility 6 points, right? 6%. So if we raise that 6 points, middle of next week, and then we look at this at 6,600, does everybody see this? In the purple there, I'd be down $543. So without a hedge, I'd be down 2,200. With the hedge, 543. Why did I go out? Can anybody say, why did I go out? My put credit spread is 21 days. Why did I go out to December 19 and buy a put for a hedge? Why did I do that? Anybody? I bought a 2 delta put. Why did I do that? Less negative theta, correct. Less negative theta. And, I generally don't want to spend much more, up to 10% for insurance. But the point is, remember, why were options invented? Were they invented for leverage? No. I mean, leverage is the most, I think, what most people are attracted to, but they were invented for risk management, right? So anyways, that's the credit spread. Um, Now, the last trade, I'm just going to show you. I won't spend this, but I said I put on a double long diagonal yesterday. It made 7 or 8% today, and it's a range bound trade, even with the big move up. So if I'm anticipating, if I'm anticipating movement, maybe in the market over the next week, and I want to do a range bound positive theta trade, like it, and let's say I'm looking at double diagonal, double calendar. Generally, I'll do a double type strategy when I'm doing maybe a little bit, 12, 13 days and under. But when I want a little more price protection, I'll just show you what this is. And then for homework, I don't know when the next one will be, maybe in a couple of weeks, the next webinar, but you could look at it. But let's just say I'll just set one up for you. And then you can tell me if you've ever done this. I'll just go 14 days out on this. This would be more of an advanced, not just because it's 4 legs, right? But as I said, this did really well today. Double diagonal. The expiration of the double you put on yesterday. Joe, I think it was no 7. What I'm doing today. So here would be an example. So here's how I would build this, right? I'll just do it with you. I'm going to sell about a 30 delta call, 30 delta put to start. So I'm selling 14 days out, and I'm going to buy the Nova 11s 18 days out. I'm going to sell a strangle out of the money call and put. So I'll go here, sell a 30 delta call, 30, 31, 67.20, right? I'm going to sell a 67.20 put. And then I'm going to sell about a 30 delta call, or 31 delta, 68.90. And I'm going to go over the longs twice so you get it. I'm going to buy my long call 5 points before my short strike. I'm going to buy my long call 5 points before my short call. So what would that be? I'm going to buy this long call 5 points before the short call. What would that be? What would 5 points before 68.90 be? I'm going to buy my long call 5 points before my short call. What would that be? Help me, somebody. Our short call is 68.90. What's 5 points before that? 68.85. Thank you, Cheryl. 68.85. Now, I don't know if they'll have this strike. They don't, right? So I might have to just ad lib it, go 10 points underneath at 68.80. My short put is 67.20. I'm going to go 10 points above that, 67.40. Something like this. Now, this is just an example to get you going on this. Let me see the date, 10/24. Why is this? It's giving me a ton of profit today. Do you see anything? Oh, I'm sorry. You have the volatility up. Now, Joe says, why do you prefer the short diagonals over the long? I understand better theta burn in the give and take of more risk. Is that why you like the short diagonal? When you are you calling this a short diagonal, Joe? Is that what you're calling it? Are you calling this trade a short diagonal? Yeah, why don't I just do this, just to give you an idea of these double strategies. So let's just say, we'll just leave you with this, just to give it, let's just say we're at 6,800. Just give you an example of the mechanics of the three main double strategies. There's many of these double strategies we do, but I'll just give you three of them, right? So what's a double calendar? A double calendar would be sell one, let's say, 6,900 call. So this is where we're at. Sell one 6,900 call, sell one 6,700 put. That's the foundation of a double calendar, double diagonal, double long diagonal, iron condor. That's the foundation. You say, what is that? A short strangle. That's the foundation of all those strategies. Selling out of the money put, selling out of the money call. If I buy my longs further out, so let's say this is, I'm just going to label this, OC 31. Say, no, that's a Friday. And then let's just say no 7. I don't even know if there was a no 7. No 7. So I'm buying further out. So I'm buying, this would be a double calendar. Does everybody get that? I'm buying further out, selling closer in. You're selling, this is the core for all these strategies. Now, what strategy is good for beginners to start with? The put credit spread I went over, Attila. I think the calendar I went over is another good one. It's just this one, the third that I'm giving you, this would be a little more medium to advanced. But the first two I talked about, I think those would be fine. Calendar's only 2 legs. Now, let me just tell you, my plan for beginners would be this. I like SPX for range-bound trades. Pick 1 or 2 strategies, but don't go more than $500 a trade. How do you do that, Dan? Do a calendar, do it 3 wide. 3 days difference between the long and the short. That'll keep your calendar $500 or lower. Do a put credit spread 5 wide. That'll keep your capital under $500. Do a butterfly. Do a balanced butterfly or something like 40 wide or something. Keep the trades under $500. Because why? Because you can trade these things. You can trade a couple trades a week on a $3,000 account or $2,000 account. Does that make sense? So I think get 10 or 15 reps under you with a strategy. I wouldn't go more than $500 a trade. Does that make sense? For a beginner, please say yes. Yeah, because it's just repetitions. There's so much you're learning when you start. You're learning, how do I put an order in with my brokerage firm? That's a pain in the rear end, right? And then how do I get good execution? Where do I put my price in? Why did they fill me so quick? You're dealing with execution. Then you're dealing with, how do I make a plan for this trade? What am I going to do if it goes up? What am I going to do if it goes down? So, but anyways, this is a double calendar. So I'm going to give you real quick, just another 2 minutes. based on this selling out of the money put, selling out of the money call, if you buy your longs further out at the money, that's a double calendar, right? Everybody got that? All right. If I buy my longs further out of the money, so that would be a double calendar if my longs are placed there. What if I place my longs further out of the money? So if this is my short put here, if I buy the 66.90 puts, that's out of the money. And if I buy the 69.10 calls, that's out of the money versus my short calls of 6,900. That would be a double diagonal. My longs or hedges are more out of the money. If I buy, again, the shorts are all the same. If I buy my longs inside this 67.10 put, inside this 68.90 call, that's a double long diagonal, right? There's three versions depending on market conditions. And then the fourth that everybody's familiar with, these would be more when volatility is in the low end of the range. When it's a little bit medium or higher end, I just do an iron condor. Buy my long, the same expiration as my shorts, right? I buy one 66.90 put, buy one out of the money call, buy one 69.10. What's that called? Iron condor. So I just gave you four strategies. This is taped with the exact same shorts. How many need a good walk around the block after that one? So think about that. And next time when I come back, I'll take a refocus on some of this because if you're like me, you learn by repetition. So next week or probably in a few weeks, I'll come back. We'll go over this again, give you another shot at it. Well, again, the shorts are at what delta? It varies for the strategies. Maybe in an iron condor, they might be 15 to 20 delta for the shorts. But most of these doubles, to give you a starting, I'm using deltas, maybe 30 deltas for the double calendar, double diagonal, double long diagonal. I'll start with a 30 delta for the calls and puts, but it could be a range of anywhere from 25 to 35. Yes. So iron condor when vols are maybe in the high end of the range, calendars, uh, and some of these other trades when vols a little bit lower. So anyways, well, I appreciate you coming in. Uh, again, if you have any questions, let me know. Um, uh, and we'll see you next time. Appreciate it. Thank you.